All right, hello and welcome. Today we are going to be discussing risk and expected rates of return. This is a very important dimension to look at because we have just already talked about it, is that when we take more risk, we have to get compensated for that risk. So higher risk, higher return. Now, we just need to figure out a way to measure this risk, okay? And so what we're going to be looking at here is we're going to be introducing in the next video is a probability distribution. But basically what it is that we look at our expected return. Okay, and that's basically what, given the probabilities, what our best case scenario is, or our expected case is going to be. Okay, so we can already think about it, right? If we walk into a casino and we are going to play some roulette, okay, if we play some roulette, is that a risky endeavor? Yes, it's a risky endeavor because there's a chance that I could lose all of my money, right? But there is also a relatively high upside, right? Is that I could make a substantial amount of money. Okay. Now let's say that I have one $100 bill and I have just enough time for them to spin a roulette table one time. Okay. So what I have options here is that I can take my $100 bill. I could take my $100 bill and I could put it on the roulette table, or I could take that $100 bill and I could keep it in my pocket. Okay. Now just think about it. A number of you are just going to say, I'll just keep that $100 bill in my pocket. A number will say, no, I'll play it. Okay. Now, just to keep things simple, let's say we only have two options here. We have red and we have black, and each of them has a 50% chance of winning. Okay. Of course, ignore right now, those of you familiar with roulette, ignore that the house wins those green. There's two slots with green 0 and double 0. Ignore those as a possibility for right now. Okay. So we can either land on red or land on black. Okay. So what that says is that if I put my $100 bill on the table, at the end of the day, when I walk out of the casino, okay, that means that I will either have a 50% chance of walking out with nothing, okay, right? Because I put my $100 bill on the table and now there's nothing in my pocket, okay? Or there's a 50% chance that I can walk out of the casino with $200, right? My $100 now got doubled. It's now worth $200. Okay, so that means that we have a 0 over here and we have 100 over here. Okay, remember that we have 0.5 on both sides. Probabilities add up to 1 always. They add up to what? 1 always. Okay, nothing upsets me more than giving 110%. Okay, you can give 100% max. Okay, but it adds up to 1, so we have 0 plus 100. So that means that my expected return here is $100. Okay, the same exact amount that would happen if I kept that $100 bill in my pocket. Okay, my expected return, my expected outcome. This is a probability distribution. My expected outcome is $100, whether I put the money on the table or I keep it in my pocket. Okay. Now the question then is, do I keep the money in my pocket or do I put it on the table? If we're looking at this from an investment perspective, what should I do? Probably keep it in my pocket, because am I getting any compensation for taking risk here? The short answer is no, I'm not getting any compensation. I put my money on the table. There's a 50% chance it doubles, 50% chance that I lose it all. Okay, so my expected return here is at that $100, which is the exact same as the expected return for keeping it in my pocket is $100. Okay, so from an investment perspective, there isn't any compensation here for taking on that risk. Okay, now we might do these things with personally because, you know, if you walk into a casino and you put your money on a roulette table, that's kind of fun, right? Woohoo! I'm in Vegas, right? However, when we are looking at from an investment perspective, right, I'm not going to be looking at investing in General Motors or Apple or whoever with the expectation that I could lose it, and there's a 50% chance I can lose everything, right, without any compensation for it. Okay, so the next videos what we're looking at is actually how we measure that risk and how we figure out, is that enough compensation for me, right? Are these odds tilted enough in my favor? Okay, all right, talk to you soon.